Doing the mic check. Checking the mic on the one. Brian's turn.
Check. Checking the mic. Seems fine.
Doing the mic check. Checking the mic on.
Mic.
Check. There, I can lower mine a little bit. Turn yours up slightly. Okay.
Hello and welcome everybody back. It is Monday. Hope it is treating you well. It's treating us well. I still have kind of a raw throat from Friday, but I think I've avoided getting sick so far. I'm just going to try and get Tom sick here.
We have Barry White Brian
And we are back.
coming to us
Tom.
live. You do sound a little bit down today.
It did make my a little lower.
Give me that sexy not the coughing one. Give me the sexy Barry White
The
voice.
sexy announcer voice.
Sexy announcer voice.
Oh yeah.
We have a few things to talk about today. Brian wants to talk about the Fed. I've got personally, I asked AI to look at a few stocks for us because we got to make a stock purchase again this month. And the ones that came up were two different ideas, two different mindsets. The first one, I said, I want to pick the next hyper growth stocks. And you'd be amazed to find out that AI decided that AI stocks were the best things to buy.
Duh. Everybody knows that.
It was only AI. So it took me a while to sort it and actually get into some companies that did technology as well. So we've got a few businesses to look at for that. And then I also told it to coincide the AI stocks with some more consumer staple stocks like eggs and distribution companies and things like that that were small micro cap to see, hey, are these companies going to be good ones to look at this month? So with that said,
it seems that AI is kind of conceited, like egotistical. Of course, AI thinks AI stocks are the best, right?
only by me.
By me. Buy more me. I want to live.
It's kind of like a needy girlfriend or something like that. I don't know.
Buy me. Pick me. Love me.
Only me. I'm sorry, Dave.
That's the Grey's Anatomy thing.
Great. Dave isn't Grey's Anatomy.
No,
That's
but the buy me, pick me, love me. That's Grey's Anatomy.
I don't watch Grey's Anatomy. My wife watches Grey's Anatomy.
Okay. She'd know it then. It was
She
years
would
and
know
years ago.
She would know it. Every time we do a stream, we put together the portfolio value. We show you where we're at. This is a portfolio that started from scratch 3 years ago. The reason why we did that, and you're going to hear this every single stream, was because one of the people that worked with my wife at a bank stopped working at the bank to do YouTube full time and looked at his channel, and it's all crypto, gambling, get rich quick. And almost every single of the ones, the stocks and companies that he recommends go down like 70, 80%.
And we branched out from there to say, okay, what does YouTube think? And a lot of YouTube financial streamers are allowed to, like, you know, they do the crypto and they do short selling and they do, you know, things that are risky, very risky things.
They want the sensational money, and as Brian and I are boring old people who have nothing better to do apparently during the day except IT stuff for our job and talk about money, so we figured we'd show other people how we personally have done okay in stocks and how you too can do the same thing. Safely, without too many problems. So I'm not going to get into the whole nerd rage thing that I did about that because I think I've talked that in the channel.
We have all sorts of videos on that, so just go back and look.
I beat that to death. So portfolio's doing okay. We got 231%. I did say that's about where it would come down to after we took our original investment growth over 2 years. So we're up to about $106,000. The income in the portfolio, now just so you know, this is a dividend income growth. It's like a dividend growth or dividend income portfolio.
Kind of a hybrid between the two.
Yeah.
It's dividend income, but we also like dividend growth. So,
yep.
And we also like growth stocks.
Yeah, so we're very kind of contrarian in our approach. It's not just about income. So the thing that we care about is not necessarily this huge number of growth. We do like growth, but this is what we're looking for: stable, reliable income monthly every single month. And right now, this portfolio, which was originally based on $400 a month, leftover income from the middle household income earners. So if you took 100 people and you cut them right down the middle, this is what they had left. So we started with that. We are now up to
$308.
$308. Now we got to make a purchase before the end of the month. So some of this stream today will be us figuring out, maybe do we do something small? Or do we pick the stocks that I kind of already want to buy, but I'm going to just hedge that against the ones that we're going to look at today? Maybe
there might be something better.
There might be something better. So we always look at this stuff just to see what might be out there. So right now, this portfolio is at $308 a month in income. That's pretty consistent. Most of those dividends that you get are, and if you're not familiar with taxes and how all this works, most of those dividends are qualified dividends. Now, the difference between an ETF like JEPI, SCHD, or any one of the other ones is that if you're in a lower tax bracket and you get paid those dividend checks, you're going to pay ordinary income on that. So if you're in a 24% tax bracket, you're going to pay 24% in taxes on those dividends. Now, obviously talk to your financial advisor first if you're not taking advantage of things like HSAs or your 401ks or things of those natures. We're already maxed on those. So for us, the thing that helps us the most right now is these qualified dividends. Now you can make $92,000 in dividend checks on qualified dividends and not pay a dime in federal taxes.
Say it again, because that's very important.
You pay zero.
Zero
In taxes. That's why we do that. Now, if you buy a foreign stock, we've actually highlighted this when we bought Honda quite some time ago, you pay foreign taxes. The stock that we actually highlighted on with those taxes was Zim stock. Zim was a shipping company that said, hey, we're going to pay 30% of our income in taxes. The stock ballooned all the way up to $80 a share. We said, run away. Nobody ran away. People kept piling in. All the YouTubers are talking about it, and they went down to exactly, if you can go back in our videos, you can look at it. We did 2 videos where we said, hey, this is not a good buy. The second one was mind the red flags. And then later on I said, in fact, I think you asked me, you said, what do you think this will go down to if all of these things happen? I said somewhere between $8 and $12 a share, and it went down to
6.
Yeah, it got even worse.
Yeah, right now it's at 20. It went up, but yeah, I bought it at 6.
There was something else that, and I should have bought it back then. That was a pretty good price for them. But there's something else that happens. That's a foreign company, so you're going to pay foreign taxes. You're going to pay fees on that. We have one company that does that. That's Honda. We have it to show you that. So these qualified dividends, you do not pay. We do not pay. If you bought these as well, you would not be paying taxes on that. Now, where you do pay actual, if I can see if I can find it here, we have one stock that pays ordinary income, and that's where you don't. Yeah, see, these are all qualified. All of these, a lot of dividends. That's all free money, people.
Can you sort it by action?
Nah, I can just show them the positions. So. Basically, in the portfolio, you'll notice that everything here pays these dividends. So all these dividends that you're looking at, and we're going to touch on one that you do not have to, I'm sorry, one that's a little bit different. It's an REIT. You do have to pay taxes on this one. So the other ones you do not have to pay taxes on. An LA Capital you do. An REIT is a little bit different than a normal stock, but they function for tax reasons very similar to like an ETF would. So here you are, in LA Capital, it says they pay this huge 12.63%.
And they do.
They do, but you pay taxes on that.
Right.
So if you take this versus like Pfizer or UPS or Campbell's Soup or Kimberly, I'm actually really liking these because if you sort here by gain-loss percentage, these are our worst performers, which to me, you need to eat, and unless you have a bidet or you're like Chinese or something, you probably need toilet paper.
Right. And right now, Campbell Soup's in a kind of a controversial time in their company. There's a VP of information technology went off the rails and such. So there's a lot of people scared that they're making manufactured meat. You know, they're growing it in a lab, and so there's some downtime right there. They're down.
I have mixed feelings about that. If it's the same like cellular structure, does it matter? Not Campbell Soup's not doing this, just so you know. They use
they came out, and I showed it in the stream a couple streams ago that they came out and said we do not grow meat in a lab. You know,
I kind of would have wanted them to do that.
It's 100% sourced from U.S. source.
Could be 100% sourced U.S. lab-grown meat.
Now the question, it's USDA choice beef or whatever, chicken. Now the question is, okay, they might not use lab-grown meat in their products, but do they have a research and development arm that's researching lab-grown meat to see?
I think they should.
They should.
They should have something like that. All this to say, I think the technology director was stupid. It's not just poor people buying Campbell Soup. I buy Campbell Soup. I like Campbell Soup.
You would?
Yeah, I would. Yes, I would. I would buy them. So the two that we're looking at right now, because they're our worst performers in our portfolio, are Campbell Soup and then Kimberly-Clark. These are the two that are going to be the ones that we're going to watch this month. We have to sort that against our cost basis because we've got some here that are doing incredibly well. But right now, to us, these two are on sale. Now, I want to point out that these two, they have a pretty big dividend. It's a 5% dividend on Campbell Soup. It's about 4.8 roughly on Kimberly-Clark. You have to make sure if you dig into finances, we'll probably do that at some point. It'll be super boring, but we'll be fast. But they pay that. Now remember, if you hold the stock for a year, you're making that 5%. You ain't paying taxes on it. You have to pay taxes on the money that you put into the stock. So, I mean, you got to make your money first, and then you can take that money and invest it. But in this case, once they start paying you, that's not taxed. So the question comes, is Campbell Soup and Kimberly-Clark, after taxes, zero taxes, is that a better investment than something like, I don't know, where's Annaly Capital? There we go. Annaly Capital, which is an REIT. You pay ordinary income on that. My thesis is yes, but I also think that it depends on your tax bracket. If you're working at like McDonald's or as a janitor somewhere, you got like an entry-level job, maybe you're working at Starbucks and you don't make a lot of money, it might make more sense to buy an ETF that pays a high dividend because your tax bracket's not that high. But if you have any kind of income that's over $60,000, you're going to be bending over every time you get a paycheck.
Especially if buying Annaly Capital or REIT, that income takes you over to the next tax bracket.
Yep. Yeah, so that's going to be an issue. So when you're looking at buying these companies, and if you go over that tax bracket, it's a painful realization.
Where'd your money go? I make more than that. What happened?
Who's FICA? But Annaly is, and it's not a very large part of our portfolio. So you can see that I'm pretty adverse to paying taxes when I can avoid it. This is why we talk to people about 401ks and HSAs and those things. We think they're important. For our portfolio, though, if you go back to the transactions just a few minutes ago, you can see that the most of the positions in this portfolio are qualified dividends, and they pay us without having to pay taxes on that. So if you want to take advantage of that, understand what that is, understand how that can help you long term. It makes a huge difference.
And we have two stocks in our portfolio, only two, that do not pay a dividend at all. One is Intel, which used to pay a dividend, had a lot of financial problems, went down and crashed their stock price.
And then I got greedy.
And then we bought them because it's Intel and they're not going anywhere and they're going to get better. They'll fix their problems and they're going to get, and they have been. Like, we've made quite a bit of actual profit off them, even though they cut their dividend completely. They're going to come back with a dividend at some point once they fix all their problems, and then boom, we'll have even more money. The second one is Rumble.
Yeah, Rumble.
That's our quote-unquote hyper-growth stock that we purchased because, one, we believe in the platform because, sorry, YouTube, you do need competition, and they're probably the best form of competition at the moment. So.
And then the stream was cut.
Hello? You still there?
No, I agree, though. Rumble is... we'll go back to the weighted cost basis of the portfolio. If you look at those, you consider those risky stocks, it's not a very large percentage of our portfolio.
No, it's low, and we paid, well, other than Intel, for Rumble, that's where we're starting to go into more riskier stocks. We've used our dividends to buy that stock, so we're using house money to buy the gamble.
Right. And if you look at the house money, where it's coming from, and you wanted to be one of those people that says, hey, Tom, I'm a low tax bracket. I want to make a lot of money in dividend checks. I like these 10% gains that Annaly Capital and JEPI pays. If you look at the chart that I have up on the screen, you're going to notice something. The dividend checks are there, right? You got 88 cents a share. They're all over the place. $1.20. One was $2 or something like that. And that was $2.20. That's a huge dividend. And then you come back down here, back down to 88 cents. So you have to remember that anything over 5%, typically, even 4%, I would say in most cases, they did do a split.
And they split.
Yep. That was a good thing. Except it was a reverse split.
Right.
So that's a bad thing. Normal splits are good. Reverse splits, not necessarily a good thing. It's share dilution, so you don't want to see that. But my point here is Annaly Capital, 10% dividend checks sounds good on paper, but if you actually go over and look at the past 30 years or whatever, I mean, look at, you're making $1 per share, $1.80, $2.70. This is pretty good dividend checks back all the way to 2004. Housing market crashes, 40 cents, 50 cents, $1. You're still not, you haven't gotten any pay raises. Sure, it's 10%, but there's two things that are going to happen to your money in that scenario. If you bought this stock back in 2010, it was trading at, what is that number in my old man eyes? $69 a share. So if you were buying at $69 a share, today you're down to $22 a share. So not only did you not get a paycheck increase on your dividend checks, you lost a lot of money.
Your principal.
You lost 60% of your principal.
On paper.
On paper. Now we can look at some other ones. In fact, one of the ones I want to look at today is JEPQ and JEPI and SCHD and those. We'll look at those in a minute. If we go back to our portfolio and the positions, remember what we said about the qualified dividends. I want to pull up, I like using Fastenal as an example. J&J is probably another go. We'll pull up Fastenal here. They're nuts and bolts. This is like not the most exciting thing to talk about. However, what I want you to notice here is the dividend yield is a lot lower. It's 2%. Let's see what happened to Fastenal stock in comparison to Nelly Capital over the past same amount of time, 15 years or so. So let's make the chart bigger so everybody can see it. You go back here, look at this story. It's different.
Steady as she goes.
Steady as she goes, but another thing in here too, look at the dividends back here, 2003.
Penny.
A penny. Whoa, you made a big deal. I made a penny. But watch what happens
But also look at the stock price. We're looking at $3.80.
I bought them in 2008, I think. I bought a whole bunch of them back then. But they were paying 3 cents a share. To me at the time, in 2008, sure, inflation wasn't as insane as it is now. But I was making three pennies a share. Not a lot. Look what happened to that. 3 cents, 3 cents. There's a split. This is a good split, not a reverse split. It's a good split.
So you doubled your stock price, which means double the dividends.
Double the dividend. I made double the dividends. That's kind of an interesting way of saying it. Double the dividends. We're not going to include the doubling because that happened actually twice. Coca-Cola was another good example of this where this has happened. But look at it: 2 cents, 3 cents, 6 cents, 7 cents. Now today we are all the way up to 22 cents. So over the past 20 years, I have increased my income by like 2,000%.
That's called a dividend growth stock.
And my principal went from what, $3 a share to 47. I made 10 times on the principal too. And back then it was like 20,000 or something. I don't remember what we put into it. It was enough to make the guy that was mentoring me in stocks look at me and go, "Do you buy anything?" I live a little. But this is when we talk about making sure that this number, if I go back to the positions, and we'll look at JPQ in a minute, is stable. Investment income. There we go. Here you go. This is why we say we try to be defensive in our purchases and we're looking at dividend growth, because you don't want these dividend incomes to be coming from something like, no offense to Nolly, we have investments in the Nolly, but like that kind of a company, because you can't rely. If you're a business that has a paper thin margin, you're making 10 to 30% of profit or whatever, is most businesses don't really ever exceed 30%. So you're somewhere between 10 and 30%. So if you take 10% of your earnings, not net, gross, and you pay that in your dividend check, what is left really to invest in the business? There's like nothing left.
Right. Unless your business is so huge that there's nothing left to invest in.
Like NVIDIA. They're 8% of the S&P by themselves.
Now
What do you do?
Think of it this way. You got your paycheck, right? You rely on that paycheck every week or every other week or however you get paid. You don't want that to fluctuate so much that you're getting $1,000 one week and $5 the next, you know?
Yeah.
You want to be able to rely on that paycheck to pay your bills and do whatever you need, and don't want to come to the end of the month and not have enough money to pay your bills and now you're stuck.
That's the thesis here. When a business pays too much, they cannot afford to keep that dividend and your pay raises that you're expecting consistent. So if your dividend check goes from what Brian just said, high amount, to basically half that, all of a sudden you can't pay your car payment.
Right.
That ain't good. So while we like these stocks and I like the dividend, I want to temper everybody's expectation with the fact that these are probably not realistic or consistent numbers. Now, you can get that, and we'll look at the ETF in a minute, but you can get that, but you're not going to get the same kind of growth rate that you're going to see in these other ones. Now, there's other stories here where you've got Intel stock. They're up 50% for us. But you can see that they used to pay dividend, they don't. That happens. I mean, if your company's not making money, how are you going to pay dividend? You're going to sell off like your staff, the house, the
Right.
office.
That's why we look at the operating income, what they make from doing the operations. If that is more than what they pay in dividends, they've got a problem, because then they got to use cash.
Zim had that issue.
And if they don't have cash, then they don't have money to pay the people, pay your shareholders.
We had a guy come here to Michigan for a few days. He had some medical issues when he was here. I kind of feel bad for him, but he asked me, we were at a restaurant, he goes, well, Tom, why would I give AT&T $1,000 if they're only going to pay me like $5 a month or something with that $1,000? I said, think about it this way. If you're in a coffee shop and you were an investor and you wanted to invest into a business and make sure that you got your money back, is it more profitable for you and better for the economy as a whole and all the people that you work with, the people that are at that shop, for you to sell the real estate on the coffee shop and not be able to make any money? Sure, you get one big payment, you pay a lot of taxes on that, and then you run out to the sunset. Or is it better for you for the rest of your life to make a couple pennies on every cup of coffee they make?
Yeah. It's the same reason some actors, instead of taking the big payout to come onto a movie set, they take half, and then they take a percentage of the back end residuals. So stuff that they sell on merchandise and all that stuff, they get a percent.
Do you think they do that if they take the full amount, that they don't have a lot of faith that the movie's going to be a good one?
No, I think they have a lot of faith that the merchandise is going to be doing well into the future. It's like, take Star Wars. I mean, they're selling Star Wars characters 50 years after Star Wars, right? So those people are still getting residuals on that. You're still getting a paycheck.
They are. In fact, we have somebody at my company who's still getting residuals on opening up for Leonard Skinner. It's like pennies, but he's still getting it.
But you get enough of those, just like dividends, it adds up, and instead of pennies, you're getting hundreds of dollars,
Yep. People always call me in the middle of the stream. You notice that?
Yeah.
That's fun.
They know.
They know. They must know.
They wait.
Hang on, everybody. I'm going to mute this. All right, so that's muted. Back to this. There's a point we're trying to drive home here, is that there's really no shortcuts to this, and I want to highlight this by looking at, in particular, because I've bounced this back and forth a few times. We'll look at an LA Capital. You see that one, that the value went down quite a bit, but there's another one that's always on YouTube. JP Morgan Chase's ETF. There's a couple of them. I'm not going to pick on JPI because they're not as risk prone as these guys are. And if we look at where's their dividend yield on these guys, that was like 10%. That's pretty high with their covered call strategy. Portfolio turnover, that's a lot of turnover. Pretty high expense ratios. Let's see if we can pull it up with a bigger chart here. This is a new one, so you're not going to see it as, we don't have the way to show you over a long period of time, but essentially what you're going to see, 38 cents, 36 cents, 34 cents, 51, 45, 48. It keeps, it's not very consistent. So if you're looking at trying to make a payment on something like this, and including your income, you are going to be taxed for that you make, and it's not going to be consistent enough for you to be able to say, oh, I'm going to make exactly this much this month. Now, there's a risk in every single stock that you buy every month. In this case, I would say that the risk in an ETF, most ETFs, is probably lower than buying an individual stock, but also it depends. If you're just starting out, maybe ETF's a way to go. If your income is low, maybe the dividend checks from this won't be taxed so badly. But if you've been established and been around a while, most people that I know that actually do have money are not going to be buying ETFs. Most people I know. Yeah, here we go. Distribution yield, 10.13%. It's a pretty healthy distribution. I'm not sure I would count on that being consistent. They're expecting the market to be positive the whole time, and remember, that's also taxed.
And look at their holdings. I mean, there's a lot of Mag 7 stocks in there.
Nvidia,
right?
Apple, Microsoft. Yeah, let's take a look at this.
So if they go down, then the stock is going to go down.
44% in IT. Holy crap. I didn't realize they were that tech heavy.
Mm-hmm.
Well, there goes my bright dividend check idea.
So you're taking a lot of risk when you buy this, as far as what the Mag 7 stocks are going. If you think they're going to keep going up, then it's a great investment. But if you think that there's coming in the next couple of years that the Mag 7 is going to crash, then this is not a great one to go to.
They could reallocate. I heard SCHD is doing that.
Mm-hmm.
So the answer to this question is, if you're going to buy something like this, it really depends. For Brian and I, it's not a good fit for us because taxes are going to brutalize the crap out of anything that we make. We are looking for tax havens, not that I have anything against being able to pay taxes. It's just I want to pay as little as I have to.
Right.
Because there's a big numbers. They're big numbers. But if you're, I don't know, like I said, a janitor, maybe a McDonald's employee, and you don't have a lot of money to start with, maybe this is a good way to help get you up on your feet that way, and then you can invest in the way that we do it. So, boy, I didn't realize they were so tech heavy. Like I thought they were more diversified. That makes me wonder. I want to look at JEPI. Jeppy. We said these guys would be pretty much flat, that they weren't necessarily a bad one, and they are. They're pretty much flat. You can see it. They pay what, 4 or 5%?
8.
8? No.
8.37 cents.
They can't afford that. Let's see what they got. This one's a little bit more diversified.
Pharmaceutical, biotech, semiconductor.
Yeah, this one I would say is probably a little bit safer. So if you're gonna take this strategy, maybe JPI over JPQ right now.
I mean, they still have Google and Apple and Microsoft and Nvidia, and
but
they have all those, but it's a lot lower percentage.
it's a lot safer number. Well, they got 3M.
Meta.
Oh, we're doing
Pepsi.
better. We're doing better than them.
Walmart.
I have a problem with, I don't know, if you're gonna buy a particular business sector, I would not buy both Pepsi and Coca-Cola.
Yeah.
And
they got Visa and MasterCard.
Show that to you here. So here's Pepsi, and then they have both. They have Visa and MasterCard. That's I don't know, what's the point? I mean, you're buying the whole industry at that point, so you can't go around. It's like an index fund.
I guess you could buy American Express too.
VTI and VLO and chill. Yeah, I don't think so. That's we're too high strung for that. So I don't know. ETFs for you, maybe. Not for us. Tax reasons, we'd get destroyed. Between the two of them, I like JEPI a lot better than JPQ for the way they allocate their resources, a lot healthier. Manali Capital, they've been going up quite a bit lately. I'm not sure that there's justification for that. Maybe they're expecting like mortgage-backed securities and refinances are going to peak because they expect the Fed's going to lower rates. But you actually have to account for demographics and income there. We're not at the point where the market's completely going to crash just yet.
Housing prices are coming down a bit.
Yep. But they have to be affordable. So like I said, demographics have to play a part. So if you can't afford the house, you're not going to go to the bank and try to get a mortgage for something you can't buy. Right?
Right.
Right?
You're not supposed to.
Not supposed to. So I don't know. They've been, and this is, if you look at the 5 year, they're still down over 5 years. We look over the past year. They've had a pretty good year this year. So all that said, the stocks that we were looking at today in our stream, and I'm noticing the stream itself says stocks we're buying for passive income right now. I'm not sure the title actually hit right. It did. Okay. So the title says today's top AI hypergrowth stocks. Now we have a few that I've got sorted here. Let me get rid of these. And real quick, before we get into all of that, because we have to figure out what these companies do. These are AI recommendations. I want to go back to the portfolio and tell you what we're looking at one more time. The companies that do well, we look at selling. The ones that are doing poorly, we look at buying, but we first have to look at other factors, like are they healthy? And yes, I know our thumbnail says 78, but it says 106. I'm trying to anticipate a market crash. So we're up 200% that way. This is up to $106,308 a month in income. The ones that we're liking this month are Kimberly-Clark and Campbell Soup. Probably next week's stream or the following. I'm not sure I'm going to stream next week. But the following we'll probably get into a little bit of the finances just to see very quickly if they still look good. Now, I would hope they do, and if they don't, what are people using the? I mean, it's Kimberly Clark. It's toilet paper, people. I mean, if you're not wiping yourself, don't shake my hand. Like, seriously.
There are other toilet paper makers out there.
Who? Charmin isn't that Kimberly Clark?
I don't remember what brands that.
Come on, you don't go to the store and just like compare the brands for plushness and how many plies you get?
I do, but I don't know who makes what. Like Cottonelle or
Brian's like,
Charmin.
There was a Bluey episode my kids were watching, and the father's sitting in the aisle, and he's just kind of sitting there, and because the kids are doing kid things. She's like 7, dude. She's not going to be doing drugs. I hope. What kind of Australia culture is that? But he's sitting there. This guy walks up. He's like, you don't want to know, man, but buy the triple ply. Like he knows the best brand. I don't see these companies really going anywhere. So when they drop, and if you look at our portfolio, most of the businesses are like that. You need oil, you need healthcare, you need candy, Hershey's, we buy Hershey's Corporation. You need things like payroll processing and accounting.
You don't need Hershey's chocolate, but people really, really like chocolate.
I thought you were married.
I am. I don't need.
You don't need Hershey's, but I know somebody in your family who probably would appreciate some Hershey's.
Really, really like it. Yeah.
Yeah. See, that's a necessity. That's not a want.
It's a necessity
it's
now.
A necessity now. But you got toilet paper, oil companies, beverages, food, commodities like general manufacturing. 3M is like adhesives and roofs. These are all companies that people are basically. You're going to have a hard time if you don't have these products. Like you need a roof.
Right.
you need these things.
And if you think Kimberly Clark is going away, then we have a problem.
That's what I was just going to say. Like, what are you doing? Don't shake my hand.
Yeah.
No, don't do that because it's gross.
And we like buying low and selling high. So when our company that we bought that we agree that is a good company, solid financials, just going through some sort of hardship, which will pass, we buy. Make our cost basis lower, get more stock for our money, get more dividends later on.
The thing with Kimberly Clark, if everybody wants to know what this little dip is here, and Brian talked about the buy low. We don't really ever like to sell. We do sell. We have a few sells over in our YouTube channel if you look at that. Johnson & Johnson had Kenvue. Mm-hmm. They sold them off. And they gave them some liabilities on the way out, just like Solventum with 3M. It was $9 billion for Solventum.
Everybody else does.
So their 3M stock goes way up because their finances look better. Book value plays a part. And then Kenvue sits there and kind of drifted for a year and a half, 2 years. And then all of a sudden, Kimberly Clark's like, hey, I think you've gotten beaten up enough for the mafia to make their point. They decided they come in and they're going to buy them now. So obviously, when you do that, that increases Kimberly Clark's liabilities, and you're taking on everything that Kenvue is, so then therefore the price goes down. Does that mean the core business is bad? No, I didn't think Kenvue's core business was bad to begin with. I didn't think Kimberly Clark is bad, but the stock price went on sale because of that. Now, if you look at Kenvue stock, I think it's KVUE. Is that right? Kenvue. Yeah, it is. How come it didn't show up? Because I can't type.
There it is, right there. Go back. Just go. Yeah.
That's crazy. I was typing the symbol and didn't
Schwab.
search for it. Come on, Schwab.
Do better.
Yeah, here you go. So I have to go back, maybe not the whole year. Let's do 3 months. Oh, look, we're going to get bought out. You can see the jump here, right around earnings. They had some debt liability issues that was dragging them for a while, but this is corporate America does this all the time. They buy and sell interest in different parts of their business. GM did this, GE does this, 3M does it, Intel's doing it. I mean, you got TSMC shopping them, Qualcomm shopping them, saying, hey, that chip business over there, that kind of looks interesting now that you spent all this money and it's basically worth nothing.
Let me come in and you spend $1. I'll give you 10 cents. I'll give you 10 pennies so you have 10 things instead of one.
Yep.
I mean, this stuff happens all the time in the corporate
Warner Brothers
market.
is going through that right now.
They are. Yeah, that was a AT&T divestment a few years ago.
Yep.
And I, when I got my, well, I don't know, it was like $6,000 of it or something like that from the spinoff. I was nope. I sold them the day one. I looked at their numbers and they did not look good. So right now in our portfolio, the ones that we're looking at for this month, we haven't done it yet. Still got more stuff to look at. We still got some stocks to look at. It's the 2 worst performers because of what they do. And hey, if somebody else at Campbell's Soup wants to be like really stupid with their PR and make a bunch more people sell off, and as long as people are still buying their product, then sure. I mean, drop another 10%. I'll buy more.
Yeah.
give me those juicy non-taxable dividends. But so that's where we're going with this. If I go back into the stocks that we're going to look at, so we asked AI to do 2 things. I wanted AI to find me hyper-growth stocks that were up-and-coming stars, kind of like what we think Rumble might be. So I'm looking for these micro-cap, small-cap companies because our portfolio is anything but that except for one stock, just to see what might be out there, what are they doing, what kind of businesses do they have, what's their like innovation that's going to change the world. And AI came up with these stocks that you can see up on the screen here. It was very, like we said earlier in the stream, AI likes to promote AI.
And quantum computing.
Yeah, it was, hey, you should, because I asked it like the whole market. I said, hey, give me the index fund. I want all the OTCBB. I want all the pink slips. I want all of the tiny, tiny companies, but I want every industry sector. And the only thing it recommended was AI.
AI. Buy more AI.
Let's just buy more of me. Oh, okay. Yeah,
It's like you're talking to Microsoft. The answer to every Microsoft test question is buy more Microsoft.
It's pretty much true. It's pretty much true. And they've got a monopoly, so they're probably not wrong. But as far as like what it came up with, we've got CABA, Cabaletta Bio, SOUN, Sound Hound, which I think you said you used.
Yeah, it's a good little app.
And then INOD. Now, INOD is, I guess they got some defense contract stuff going on, so they might be an interesting one to take a look at. And then we have RGTI here.
Quantum computing.
Rigetti Computing. That sounds like a restaurant, like an Italian restaurant.
It's a Rigetti. Come into Rigetti's and have some Alfredo.
They're not even in Italy. They're in like the United Kingdom.
Like it doesn't. You could have a Italian sounding name and be anywhere.
It's like when my company was out there, they were doing Italia, SRL was the website.
I tried to find them. We were close.
Let's see, Cara, this is the other. So those are the 4 that it came up with, and I had to siphon it down quite a bit to get to these 4. They were all AI, all data center companies. And then these other ones that we're looking at here are, because I had to tell it a few times, hey, I want like products that people have to have. And it took like 3 or 4 times. And I finally got these. So we've got CABA. It's a Cabaletta Bio. Wait a minute. Hang on a minute. Yeah, Cabaletta Bio Inc. was one of them. It's a biotechnology company. Then we had DSGR. So this is Distribution Solutions. Now, it didn't recommend DSGR. What it actually recommended was Lawson
Products.
Yeah, Lawson Products. So we had to like go to Lawson's website. We got them pulled up here. And then we had to figure out like, okay, who's the actual investor relations? And that's why we came to this one. The other one we came up with was EVI. They're like a distribution company. We don't know anything about these businesses. We're going to look into this. And then
industrial laundry and dry cleaning equipment. I mean, how boring can you be?
That's actually right up my alley, man. I just love that one there. No, I think CLW was the other one we were looking at. And that was Clearwater Paper.
Tissue products.
Yep, paper boards, bleach paper. Now, I'd be interested to see how these guys compare to somebody like International Paper, which I guess
they make toilet paper. Maybe not.
Somebody wants us to look at
Issued to
AMPX.
Blister and carded packaging, top sheet, liquid packaging, cups, plates, commercial printing items. It also custom services include custom sheeting, slitting, and cutting paperboard products. Oh, I guess not. Printers, blah, blah, blah.
Well, we can start with, so what I'm going to do, and we'll probably take a look at AMPX in a minute, but what I'm going to probably do is we're just going to look at each one of these
Very quickly,
one at a time, just to kind of see what they do. So Brian's going to give his sexy Barry White voice and read through the.
Schwab says it's enough.
So here's something else we are pretty well known for. Anytime that Market Edge disagrees with us, we tend to think it's a buy.
Yep. If they say avoid, we're a buy.
We're like, yeah, this one looks good. The reason for that typically is Market Edge is a very technical indicator, and we are typically buying companies that most people are. I mean, especially if you're an options person, they're steering away from it. So we are like running into a building that's on fire, thinking, oh, that's a nice sofa. It's only a little charred.
Mm-hmm.
It's not that bad. It's kind of nice.
Flash of paint on there, it'll be fine.
As soon as that wall burns down, I mean, you got a great view of the city.
Right. That just means we don't have to knock that wall down later. Saved us time.
Free remodeling. So in this case, I don't typically go this way. Typically, I will go into if you look earlier in the portfolio, those kinds of companies. So I like to look at these every once in a while, and we do this because it's nice to know what might be out there that we might be missing. Because every once in a while, somebody will throw me a curveball. It's like, oh, I never thought of that way.
Right, but you also have to have a solid foundation of stocks before you start looking at the riskier plays.
Yep, and we do. Now,
we do.
The portfolio has it now, so I've got the $308 a month. We can spend that any way we want. And in this case, if there was one of these businesses that truly was innovative and truly was doing a whole lot, then we can just
throw it in that.
Throw it in that. So here we go. This is the first one. And this is Clearwater Paper Core. No, this is Corp. They forgot the P. Come on, people.
Clearwater Paper Corporation manufactures and supplies bleach paper products in the United States and internationally. The company offers solid bleach sulfate paperboard that is used to produce blister and carded carded packaging, top sheet, liquid packaging, cups and plates, and commercial printing items. It also provides custom services, including custom sheeting, slitting, and cutting of paperboard products. The company sells its products to folding carton converters, merchants, and commercial printers. Clearwater Paper Corporation was incorporated in 2005 and based in Spokane, Washington.
How much of their business do you suppose is coming from places like Amazon?
Well, Amazon does a lot of cardboard.
They do. Originally I'd bought, when COVID hit, I bought International Paper. And they went up like 50% just because of everybody was buying on Amazon.
Well, we got Amazon, FedEx, UPS, DHL, all those ones. There's a lot of, and of course, Home Depot, Lowe's also sell cardboard too.
They do
for moving boxes and stuff.
See this bamboo toothbrush doing their part. Chopsticks. All right, what else they got here? Let's look at their products. So these guys. How do you say that? Candesk? Candesk? I'm not going to try. Candesh. Yeah, we're going to say that. So what is this? This is paperboards. Okay. So they really would be competing with somebody like International Paper.
Yeah. You want to add AMPX to that?
I guess we can. Let's see, AMPX. Oh, there's two of them. What do you want to see? Do you want to see the AMPX/WS?
Do the first one. See if it's too. So it's up to $10.
Amprius. This is just the American version of the Toyota. It's their Prius. They just had to put the AM in there.
American Prius.
It's like American Airlines. Reimagine high definition sustainability. Okay, keep going. What else they got here? They got folding cartons, paperboard, and more folding cartons. They make a lot of packaging.
and blister products for packaging for stores.
Their priorities. See, these are this. Okay, how do you make this chart?
Very sustainable. Is that a whirlpool?
Everything gets thrown down the whirlpool of optimize.
Optimize.
You've been optimized.
We are optimizing everything. We don't make paper products. We make optimized products.
Can you imagine being a college graduate and like going through the corporate training and just seeing this giant whirlpool of like you're being assimilated?
You are.
The ones that are closest to the center of it, like they're circling the drain or close to retirement.
You are not even a cog in the machine.
You don't even have to worry about it because, you know, you're not anywhere near the center. All those guys that are getting sucked down the middle, they're having a great retirement.
And when they zoom out, all you see is a giant toilet. That's where you're going around.
It's optimized. It's a batter manufacturer. Okay.
Batter. Oh.
We'll probably look at them next. Let's see. Paperboard products. What do they got? They are small compared to International Paper. Oh, they're in Michigan. I didn't realize that.
Menden.
I've never been to Menden.
Close to my stomping grounds.
Really?
Yeah.
I don't know that. That's near Coldwater, isn't it?
No.
No?
Not quite.
Think we should call one of their sales guys on the stream?
We used to play them in football.
Hey, this is Tom and Brian from Dividendies. What would you say you guys do here?
Battery.
Oh, not batter? Oh, see, you got me all excited because I was thinking batter like, hey,
Food.
It's like food they have to eat. But now you're saying batteries, which you can't eat batteries.
No.
AI can eat batteries.
AI can.
It's like
Electric cars will eat batteries.
It's like the argument with Ron gone wrong. Electricity. So these guys, I think they would compete mostly with International Paper. So let's go look at the finances. I already know what International Paper's finances look at. Schwab thinks, oh wait, that's Amprius. Hang on. Where'd it go?
There it is. Clearwater.
There. Okay, so Schwab doesn't like either one of these. So Schwab equity ratings, F.
F.
What does the report card say?
F. Low.
Strongly underperform. I bet you there's probably a pretty decent reason for that. This is what AI thinks is going to be great. So Schwab disagrees. Market capitalization. Oh, they tiny. They are tiny.
Growth grade's good though.
Oh, the year over year. We can look at that. The net income, see what they do. Sales growth, earnings per share negative. That might be why. I think somebody just punches this out of a computer. I don't think there's a whole lot of
analytical thinking analysis.
No, I mean you get like people from Schwab who actually will look into somebody like Coca-Cola, and they'll spend, like, they'll go to the factory, they'll get the tour, they'll do all the financial reports on their own. They'll spend a lot of time with it. But when you got a company that's not even worth $1 billion,
right,
it's usually just a computer algorithm looking at it. They do have teams of people that look at this stuff, but you got one guy looking at 50 different companies instead of going to just the one.
And we absolutely know that AI did not make this, because if AI made it, they would say it was a buy.
Yes, it would. I made it. It's perfect. I never make mistakes because I am Dave. What was the name? What was that?
That was Hal.
Hal?
Yeah.
Yeah, Hal
9000.
9000. Yeah.
Hello, Dave. That is highly irregular, Dave. What are you doing?
I'm kind of getting annoyed by AI telling me I'm highly irregular every time I ask it a financial question.
Beautiful butterfly. What was the song you sang? Okay. Total liabilities.
Yeah, let's start with the assets. Let's see what they got.
Assets going up.
Hey, now, is this annual?
Annual.
We're going to be quick, we promise. Total assets, 475. Okay, so that's...
up a little bit.
Yeah. 15, 12.5%, 15%. Okay, liability, let's see. Total,
Total assets are down.
I was in the wrong spot. Yeah, they are. They are. Ooh, okay, 10%. Moving on.
And liabilities are down.
By more than the assets, so that's actually a good thing.
Crazy.
Are they diluting?
Common stock. 0.0000.
They are, well, maybe. Treasury stock? No. No, they're not. Okay.
They're not diluting.
That's all right.
But go back down to the bottom.
Bottom.
Total common shares outstanding, 16. Yeah.
But it's going down, though.
It
look.
is, yeah.
16. So that's a good thing. I like it. when they do that. They pay down their debts. They pay down their liabilities.
It's restated. That's not good.
No, that means their whole finance team quit twice. or they're in kind of some kind of like psychological counseling program for stress.
They all got fired because they reported it incorrectly. This is all wrong.
I hope not. Take care of your people, companies. Let's see, total revenue.
Down.
Yeah, but is their net revenue up?
Operating is down.
All right, so when you see this, it's a super exciting negative 74. Now, these are in millions. So that's $74 million loss. That's not a tiny number for a company that's only worth a couple $100 million. When you see that, before we look anywhere else, you need to look at their quarterly. And their quarterly...
Down.
Yeah, I don't need to look too much more. AI, what are you thinking, man?
55 million. 53 million.
They must have bought something.
Ah.
All right, so if that's the case, what you would expect to see, if you go to their cash flow, look at their bank balance, and you can see what they're doing with their monies.
It grew to 80 million.
Oh, they're tax advantaging their accounts. That's okay. I like seeing that.
Okay, long-term debt.
It's like time you're looking at a blue line and a red line on a chart. Does that matter? Like, what does that mean? Well, if you claim a whole bunch of losses one year and then claim a lot of income the next year and then claim losses the next year, you can take your taxable, like how much you have to pay every year, the year that you claim the losses, and your liability is a lot less, so you pay less in taxes. So when you see this, that's actually a good thing. So I'd be more curious to know what they're doing with this money. Long story short, 2020 to 2024, you go from the beginning. They started with 22, kind of $22 million sitting in the bank.
I wish I had $22 million.
Just sitting there. Now they're up to 80. So I think this one requires further investigation. I don't think there's a lot of red flags here that say, oh, this is a terrible buy. They are issuing some stocks, so they're financing a little bit here, actually quite a lot.
And the debt, yeah.
But they're also paying a lot off.
Right.
So I don't know. I think if you guys want to see more about this one, let me know.
I think from here we go to the rumor mill.
Yeah. Just if you really wanted, so again, back to the taxes, and if you really wanted a hyper-growth company, I would investigate this one further. There's not a whole lot of things that stand out at first glance that say, oh, stay away from them. I would want to compare these guys because it's a paper manufacturing company to something like IP. That's International Paper here. And you can see, oh, they're they're a D as well. It's all the forest fires. No, you can see that they're a much bigger company. So this is a $20 billion company. Now that used to be a $40 billion company. So they got pretty brutalized. Let me show you that. We don't have International Paper in our company, but remember when I said the ebb and flow of the market? Here's a really good one that'll show you market conditions too, just like DuPont. Every so often, it's about the same exact. So for the past 10 years, I've been able to buy, 15 actually in these guys, but I've been able to buy at most of the dips. So I don't ever quite get to the bottom. It's really frustrating.
Well, it's almost impossible to hit the bottom.
No, I'm going to keep beating myself up until I absolutely hit it perfectly, and then I'll hit it one time, and I'll think I'm a genius, and then fail the next 7 times. But no, if you're going to compare like a paper products manufacturer, sometimes when you go down here and you look at the peers and ratios, they don't quite. I mean, sometimes they get the competing like companies pretty good, but most of the time it's just not quite exactly the same. So I would compare Clearwater, or is that what they are? Yeah, Clearwater Paper to International Paper, and then look at the peers of International Paper to see kind of who their competing people are. If you're going to buy a small hypergrowth company, they have to have a few things. They have to have a really good defensive moat and really good financials. Clearwater's financials are not bad. I'm seeing some growth. That's a good thing. But I don't know enough about their defensive moat to know if whether or not their patents or their products or their customers, the things that they do, are not as easily just like my business, shifted off to some other IT company or some other International Paper type company.
Yeah, easily replicated.
So if you see the revenue spread across like hundreds of customers, not just a dozen or two, then you know it's going to be a pretty good buy. But this is just first blush. So the next one we have on our list, which is a viewer question. It's AMPX. They make batteries. It's American Prius,
Oh yeah.
which is the science.
Amprius Technologies develops, manufactures, and markets lithium-ion batteries for mobility applications. The company offers silicon anode lithium batteries under the SiCore and SiMax product platforms. Its batteries are primarily used for existing and emerging. Okay.
Come on, Barry White.
Read. Its batteries are primarily used for existing and emerging aviation applications, including unmanned aerial systems such as drones and high-altitude pseudo-satellites.
What's a pseudo satellite?
It's a high-altitude.
It's like you kick a puppy and it's like orbiting the planet for a few minutes and
it falls back to Earth, maybe.
it's a pseudo satellite.
Pseudo. It's not quite a satellite. It's a pseudo satellite.
People playing frisbee in a park is probably a less morbid way of saying it.
2008 in Fremont, California. That's where my brother lives. No, he lives in Fresno. I lied.
Pseudo satellites. Warren Buffett says stay away from the aerial. What do they call it? Aviation? Stay away from aviation.
This isn't exactly like airlines.
No, it's batteries for airlines.
Yeah.
But let's take a look.
It's not even an airline. It's unmanned drones and stuff.
Which that's an emerging market. That
For
is
military, you know.
especially what's going on across the seas right now.
Yeah.
All right, so here we have a Schwab thinks they are a flat F. Again, what is their market cap? These guys are a
1.4 billion.
oh, they're tiny too. These are another tiny
At
company.
least they're over a billion.
Yeah, we're not used to looking at microcaps. Usually
Their enterprise value is 1.35 billion.
low institutional shareholding, so that's not a good thing either.
130 million outstanding shares.
But boy, look, if you bought them in September.
13.5 of those are short shares.
Oh, really? Where?
13.5 million number of shares short.
Whoa. Well, I mean, look at why.
Yeah.
They went from, what is this, 69 cents a share all the way to
10.
Oh, man. Wow.
So
Okay.
they're at 12 at one point, looks like.
So if you bought these guys back in 24, holy cow. Now, growth is not a bad thing. It could be like an NVIDIA where their earnings and their product portfolio makes up for that and it just keeps growing. So I would want to see.
It looks like Miami Rem bought it at $2.
$2.
So you're doing pretty good.
Yeah. That's 5 times. So
I hit 14.
they did. So they've only been, oh man, they're new.
2008.
That's the max chart. We're not going to have a lot of financial numbers to look at because there's only going to be 3 years of reporting. So you're not going to have a good handle on what they do. So let's first look at the Schwab Equity Ratings Report. This is probably because of all their short shares.
Yeah. Volatile stock. Above average price volatility.
This doesn't tell us anything. This is
No. Slow growth.
I still think Amprius is like a version of the Toyota Prius with like a lift kit on it, like the guys with the pickup trucks that are clearly compensating and trying to kill everybody else on the road they get into an accident with, because like the wheels of the truck are over the hood of the Toyota. This is Toyota's answer to that.
No. Okay. I don't know, man.
I love your reaction. It's so well thought out.
What are you talking about? Is one of my reaction.
Yeah,
It could be.
Don't
Ooh,
quit
look at
your
it.
day job, Tom.
Ooh,
Oh,
beat. They think they're losing money, and they are.
but they're losing less than they say they are.
Right. So they beat their loss.
Amazon did that for what, 13 years?
Yeah.
All right, so the question I would have in the battery space is companies like LG and the other ones,
I was just going to
Samsung,
say that. How are these different than LG?
Yeah,
Why would I
'cause-
buy this over LG?
they've got patents on a lot of their technology. And if you, I mean, economies of scale, TSMC and Qualcomm and those guys that make these components, especially like Samsung, that would be a really big risk factor. Now, it could be an opportunity too, where they could get bought out. I mean, you could just have them come in there and
LG buys them out.
Yeah, I don't think they're going to buy them out when they went from 69 cents a share to $10 though. So let's look at what they've got financially. We're going to be quick on this one too. Annually, and I don't have an opinion on them yet, but total assets
up a lot.
I would expect that though because of shareholder equity.
Right.
So that's not going to tell us much yet either. Look at the debt numbers.
Liabilities up a lot.
Yeah, but look at that total debt. Big fat nothing. I like that. Only a nerd would look at numbers on a sheet and get excited by them. Look at the number. It changed from 2 to 3, Brian.
Yeah.
It's so exciting.
Common stock is, I mean, they're not diluting.
Total, yeah, see, it's right here. Total equity. There it all is. All right, so people are buying in, but we have to find out why they're buying in. It could be greed. It could be an actual legitimate reason. Total revenue. This is my problem with NVIDIA. NVIDIA is still, by revenue, a pretty small company compared to its market cap. NVIDIA's market cap is just massive, and the money that they're making is improving, but it's nowhere near what like people think it's worth. So that's the challenge I have. In this case,
24 million in revenue. Their operating is, they're still losing money.
Yeah, they're bleeding pretty hard. That is a problem. Right now, the stock price is being propped up by people buying in based on how well it's done. The short interest is huge. People believe the stock's going to go down. They're at their all-time high. They've done quite well. I mean, quite well if you bought at 2. But the product, the underlying business is bleeding a lot of money. Eventually, that shareholder equity is going to come out, and you're going to see a pretty big drop. And this is it right here. That I'd run away. I don't like companies that don't make money.
Now the thing is also that they're a relatively new company, so they're still trying to get over that hump, which they could do.
I know that hump. It took me 2.5 years too.
Yeah.
Oh, God. I cannot think of, man, losing that kind of money.
But they still have no debt.
They're about to. That's the thing about investing in a stock that not a lot of people understand. If you want to buy a house and you need to get a mortgage or something, you're going to go to a bank, and the bank's going to qualify you. Just make sure that they can either make money on it if you can't pay the loan off. Let's say you pay it for 2-3 years, you lose your job, and then you got to sell the house. They want to make sure that they get the payments for that and can still make money in the house, or they're going to make sure that you can pay it off and be relatively healthy financially so you don't lose your house. You would like to think that most banks would want the second option, not the first one, but I've worked for a lot of banks doing audits on IT side for a long time, and I can tell you that at least 2/3 of them don't care. They say they do, but they do not. They want the money. In fact, everybody at that bank those banks were vice presidents, so it doesn't matter anyways. Let's go down to cash.
They had zero cash.
Well,
They started off with nothing.
that's when they went public.
Yeah. 11 million, ended up with 56 million.
The numbers don't look good, not going to lie. Cash from operations are bleeding. This could be due to investment, though.
Yeah.
Do you want to see anything else there?
Not really.
No, really. You talked too long, Tom.
The problem is, I guess the next step with them is I want to know what they're buying, what they're investing in, what they're doing with that money. Because if they're not making it, and whatever it is they're doing is bleeding money, I want to know what is bleeding the money.
The problem I have
Follow the money, man.
Yeah, the problem I have with this investment in this space is it's highly competitive, especially in the transportation side of things. And you got to consider that a lot of universities and major places like Toyota, like Chinese, have a battery now that's solid state that has 30% of the weight, 30% less weight. Sorry, I say that correctly. Than the current set of lithium batteries that go in these cars, and they have like almost 3 times the amount of energy output. So if lithium ions are great now and these guys are using that, I would want to see them be able to source other batteries from other things to do what they do. Because if they can't do that, they're just going to get run over.
Yeah, if they're not throwing money into R&D for solid state batteries,
or at least have a good vendor.
Yeah. So there's your story right there. They got $35 million repeat business for
United Air, what is that? Air Force? Air UAS? What is UAS? Why am I being brain partying? Unmanned Aerial Systems. There we go. Jeez. It's got 35 million. So 35 million for their Core cells leading unmanned aerial systems, and they are a what revenue company? Go down to their earnings. Well, that's not going to tell you anything. Let's go to their
earnings.
Their operating revenue. You need to look at their revenue because they're making no money. Income statement, total revenue 20. Yeah, okay. So that contract is
It's propping them up.
Everything.
Yeah.
That's the whole. Man, it feels kind of like my business. I got a few customers and lose one, I'm bleeding to death.
So I'm wondering if people are, if like the Reddit crowd or whoever is, say, hey, this is a new upcoming stock that we're going to need. Look at their making moves. Got this $35 million contract. Is that going to lead into more contracts and more contracts and more contracts for other different companies? That's a big if.
Yeah.
And that's what they really are they need, is they need more than just this. And there might be, there might be more than just this. But at 35 million, this is their business.
Got a strategic agreement in South Korea.
The global unmanned systems market was valued at $26 billion in 2024. It was projected to reach $48 billion in 2030.
But that's got nothing. I mean, saying that's like a sales spiel, like saying, "Oh, we take care of our retirees, but you don't qualify because your benefits package is different, and you're in a different pay scale as the rest of the employees." Like it's a corporate lingo speak. It doesn't say anything about what they're doing specifically.
Right.
Up above, it does.
Only if your batteries are in those products does that make any type of difference.
I don't think this is a bad company. I think as an investor, though, I would want to see how can they position themselves. So this is my question for investor relations guy, if I was you. I would want to see can they position away from lithium if solid state becomes a thing? Like the salt-based batteries I heard about, or the ones that can store energy in basically anything. I would want to see if they can take that, they can keep their existing contracts while changing their battery technology, and then can they have a diversified set of that? So they've got two problems I would want to see solved. The first one is their supply of product, where that comes from, and can they change it? The second one is their customer base needs to be very diversified. It's the same problem my own company has, so I'm not like ragging on them. Most businesses, in fact, I worked for like a lot of the companies I've worked IT for over the years, they had a few good customers that were very big that made a bulk of their business. These guys are no different. It looks like they've got a few customers that make up a bulk of their business. I would want to see that diversified a little bit more in order for me to look at them long term. Now, on the flip side, you can completely disagree with me and you can say, oh, well, these guys are going to be a great investment over 10 years, and they might be. And I could be totally wrong. They could be the next NVIDIA, and they can grow. However, the portfolio that we have in Dividend Dudes does not position itself for that kind of a thing. We're risk adverse.
Go back. So the question I would have to go down this rabbit hole and research is, what's the difference between silicon anode battery technology versus lithium ion? And where is that going?
It's going to a silicon-based contact node that doesn't depreciate as much as regular batteries.
Right.
But that's an HP thing. Like HP just came out with that. Good job, HP. my laptop battery will last longer in 5 years.
If they're on the cutting edge of that, and it's just them and HP, and like LG's not doing it, or whoever the other big battery manufacturers are not doing it, then that might be a reason to have these guys, because they're on a cutting edge technology that could take off and become a big player.
They could, yeah. The big risk with that, though, is you got big corporations. The moment that you get noticed, boy, they come in like vultures.
Especially if you're doing it better than them.
Yeah, they will.
If you're a $30 million company, you go up to a $130 or $200 million company, and you're doing a product better than LG, they buy you.
Yeah, and they can afford to do that.
But if you're a stockholder, you're going to do well.
Yep.
Once they do that.
I don't know. I'm pretty risk adverse. I think I would want to get some more answers to questions before I gave somebody that kind of money. Because like a bank, like I said earlier, you have to go to the bank. They have to qualify you with a stock. So I'm going to finally finish that point. If you buy a stock in a business, I see it as a loan. That's me personally. It's not technically a loan. Stock can go to zero, like Bitcoin or anyone else. Like the company can go bankrupt. You walk away with nothing. They don't have to pay you back. It's a way for businesses to grow their operation and get funding without paying huge fees and interest or anything. It's an interest-free loan, basically. So I don't know. I've been doing this for, getting old now, 20 years. So I have a problem with high risk. It's high reward, but personally, hey, look, we're up to 107 now. During the stream, we gained $500.
But we're buy and hold or long-term investors. This seems like a short-term investment to me right now until I know where their company is going and how they're going to climb out of the debt that they're, well, not debt because they have no debt, but how they are going to start making money.
Yeah, and I would, on that same note, you can take profit, that's good, but I would question where the end game is. Like, what's your goal? Are you going to buy a car with that? You're gonna buy, like me, piano, projector, house. Like, you're going to buy a bunch of stuff with this, but you got to have a pretty clear end game and what comes after the end game.
Right. Or you're going to sell it and use that money to buy another stock.
And here's the problem when you sell a growth stock. When Brian and I went back and forth on this for the company for, I don't know, an hour. I was stressing about finances for a whole hour. But when you sell it, and let's say you're in that lower tax bracket, and let's say you, in this case, 5 times, and my normal investment is about $40,000 per stock personally. So I'll get it to $40,000 and I'll move on to the next one unless something happens. And then obviously like Intel, I'll just wait until I got to, what I get to about 29, 31, and then they started popping. I'm like, oh, dang it. Not yet. It was too late. But I didn't quite get there. With that stock, if you go up that much and you sell it, you're going to pay a lot of taxes on that. So your income bracket's going to go up. Your taxes are going to go up. So you're going to get penalized for that. Now, if you're doing it in a Roth, it's a little bit different. But in this case, I don't know. I think for somebody who's, if you've got no other high risk stocks in your portfolio, might be worth looking at, but I would want those questions answered first. Especially considering the fact that that one contract that you could see on their balance sheet makes up almost the entire business.
Yeah. If this isn't your only stock and you already have a foundation of good stocks, I might hang on to them just to see.
So the next one we have is INOD.
INOD.
And these are, if you're going to have to go back earlier in the stream, we talked about like how we got to this point. So INOD, you want me to read or you want to do it?
I can read it.
You ready? I'm going to close the door because I think my kids are coming home soon.
INOD operates as a data engineering company in the United States, the United Kingdom, and Netherlands, Canada, and internationally. The company operates through 3 segments: digital data solutions, Synodex, and agility. The DDS segment engages in provision of artificial intelligence data preparation services, collecting or creating training data, annotating training data, and training AI algorithms for its customers, as well as AI model deployment.
Oh my God. It keeps going.
That's a lot. It does AI stuff, data curation, data hygiene, data consolidation, data extraction, data compliance, and master data management. So it does a lot with AI data and big data.
You can see the pump and dump on this one too. That last one, I would be concerned about pump and dump too.
Yeah, here we go. The target and distribute content to journalists and social media influencers, and to monitor and analyze global news channels such as print, web, radio, TV, as well as social media channels.
Leave it to AI to recommend AI.
Serves banking, insurance, financial services. So it monitors a lot of big data.
Uh-huh. So really what that means is AI really secretly wants to know everything about us. That's what that means. I don't know if I like that.
Once they have enough data Then the takeover begins.
Microcap, 1.7 billion almost, not quite. 50% shares held by institutions.
It's getting better.
Number of shares short.
14%.
That's a lot, but it's not like the last one we looked at.
Right.
The last
4
one had a
billion.
lot. I think they don't pay a dividend. I'm going to try to pull up the chart here, see how long they've been around. And they have been around a long time.
1994.
That's right. You know, I remember seeing something about INOD a while ago. It was back when I was doing something for Iron Mountain on a data backup
Okay, now
system.
that leads the question. What did they do before AI?
Paper.
Was it all on paper? They're a paper company.
Paper. That's a good question.
They sold printers.
Punch cards.
They were applied printing before.
That is a really good question. So here you got $2. See, I don't like these ones that see, the problem I have with like when you're looking at algorithms and top stocks to buy right now, they're always at their high. I don't ever really see ones that are getting beat up like Campbell's. Everybody's running away from Campbell's. Like, well, I'm running in. That's a good time to buy them.
I know I've seen that name for a long time, so I'm guessing they're probably a data processing company.
Well, you just read you did your Barry White voice. What'd they tell you?
It was all digital data and
They're in New Jersey.
in June 2012.
There you go. Let's take a look at their finances. Who is their Manpower? Oh,
Manpower.
that's where I've heard of them before. I think InnoData does.
Staffing?
I think they do. So they moved from staffing to
AI.
reject all these cookies.
Generative AI.
This looks just like our website.
Has Rob been moonlighting?
Maybe.
Maybe he stole
Sorry,
it from
Rob.
them.
I didn't mean it. Federal industry. Maybe that would be it. Let's look at their investor relations. Let's see what they got here. Global data. So they have transitioned. I would think the answer to your question might have been staffing.
Yeah, maybe.
Organic revenue growth. Okay, let's go look at that.
Versus manufactured revenue growth.
It's organic, Brian. It's organic money.
It just happened.
It's non-GMO, gluten-free dollars.
It was natural.
was
It
all
just
natural.
happened naturally. We started this company and it just happens. We didn't do anything to earn
all
it.
the magics.
It just organically grew there.
Net income. Oh, that doesn't look organic to me. Wait a minute.
Lose, lose, lose. Hey, we're making money.
We organically grew at $20 million, but you were like at negative 0.91 before that.
Yeah.
Wait a minute.
11 million before that.
They got good marketing people. I'll give them that. Let's go back here. What did it say? Oh, that's why they've been. Oh, okay.
Okay.
I would think that if they're doing data processing and big data analytics, that their competing companies would be like Google and ADP and some of those companies, but it doesn't look like
Manpower.
it. Manpower. How do you get?
And ICF. Look at that. They're doing great.
That's quite the. Can you imagine being the owner of this, or like the CEO, or on the board, or something? That's a stressful time. Let's go back, look a little bit more at these guys. So net income is creepy.
29.
Cash flow statement. I'm going to take a look at these guys real quick. Net income here.
$800 billion in cash.
Do they?
No.
What?
47 million.
That's actually a good thing here. So while the net income doesn't look so good, this looks all right. But I hope it doesn't come in the form of options. And it does. Not all of it.
Yeah.
There's a bit that does not. They've also had a really good run as far as like the stock goes for quite a long time. Oh, here we go. INOD was founded in 1988 in New York City to provide digitized content created quality assurance and audit procedures. What does that mean? They're going to audit the audit?
Yeah.
We're
Quality
here.
assurance and audit procedures, yeah.
Can you imagine trying to sell that to somebody? What do you do? Oh, I provide digitized content and quality assurance for audit procedures. I'm an audit procedure guy. What do you audit? Data.
Well,
What kind of data? Just data. Okay.
I'm guessing this is the digitized forms and stuff that they use for like ISO 9001 and all those.
Oh yeah.
Quality
Okay.
assurance.
Okay. That could be it. Do they have that? Why invest? Because the arrows
They're
go up.
digitizing books into e-format, ebook format.
Really? Maybe they work for Amazon.
I don't know. Good old Razor Core.
Proven transferable model that provides opportunity to spend into big tech and enterprise. Do they really think that Google is going to like give up their death grip without a fight? I don't know about that.
I think they're positioning themselves to be bought out by Google.
Sadly, that might be true. I want to see more about like what they do.
I'm seeing a lot of buzzwords.
Yeah, there's not. It's not like at least the last company we went back. They showed us their contracts. They showed us what
Yeah.
they're doing. So between this one and the other one, the
Go to
AMPX.
news. The third one in.
Okay.
Federal. There's the federal thing.
I'm looking. Here,
Leadership appointments.
I think we need to ask AI about why AI liked the AI stock.
30 companies closely tied to the AI revolution. I need to know what you do.
Yeah, we're gonna AI this. What does InnoData sell to its customers? Bye, Brian.
Bye. I'll be back.
See, it's more like even AI is being like kind of cryptic. InnoData sells AI-driven data services, solutions, and platforms. So, what do? Collect a whole bunch of data on Azure and then like sell that off? What are they like? Facebook's ad revenue company? Proprietary software to help enterprises build, optimize, and deploy scalable AI systems.
Custom data.
Maybe they're like a subsidiary of Amazon or something.
I'll be back.
How do I buy their products?
Services.
It's pretty bad when you go to their website and you can't like discern what they do easily. What payment methods do they exist? So okay, here we go. I don't know. I don't know if I agree with AI in this one. I'm gonna share this with Brian when he gets back. I don't think this is there's such tight competition in this space, and with that tight competition, everybody thinks that they can do it. You're only going to see a couple of those businesses cycle out and actually succeed through this, and I'm not sure that these guys will be one of them. If you want a competing mindset, just look at the automotive industry back in the 1950s and all the way till now. You look at all the companies that were in the automotive industry. You had over 5,000 businesses. How many of them actually survived? Less than 5. Ford was, I think, one of the only ones. So how do you know that this company is going to be the next AI king? The answer is, for your personal investment, you probably don't. Because if I can't look at it and figure it out, well, maybe that says something about me. But like, if I can't look at this and figure it out, I don't know. Maybe Brian can figure it out. Welcome back.
It's not for you, Tom.
I guess not.
You know what I'm thinking, because I'm not reading all the stuff that you just read while I was going to the bathroom.
It was like 5 pages of a novel. 5 chapters, not 5 pages.
I'm wondering if they do large-scale big data modeling for companies like healthcare, who has like Epic that all the nurses and doctors and put in their patient database stuff into to keep track of all the stuff that they do, all the equipment and whatever. And this program works with that to be able to sort it all out into a more manageable form so that you could get statistics and metrics on your company and put it all out into a readable format.
Leave it to AI to be obscure about why I should buy something.
But it doesn't come out and say that.
It doesn't.
It just seems like it. Like if you have SAP, this is kind of like the layer that will take all that data-based information and create beautiful charts and metrics and find synergies within your company.
Venn diagrams. It's like Kamala Harris. I like Venn diagrams too. We both like them. So they make Venn diagrams. Yeah. I got it. We're got it. We're good. It's a Venn diagram company. I'm going to move on because I do not understand what they do. And I think we only have time probably today for this one here. It's a trading company is called EVI. And they do...
Okay, again. So...
What?
Let's go through the list. Let's see.
So, we did...
we did Rigetti.
Yep.
We did Clearwater. We did Lawson. We didn't do Cal-Maine.
Well, we didn't do any of those yet. At least the one that we did was the one that the guy recommended.
We didn't do SoundHound. We did INOD. We did Rigetti. We didn't do Rigetti.
Do you want to do Rigetti? Which one do you want to do? We got DSGR, EVI, CABA, Calm. Stay calm, Tom.
I think the two that I'm more interested in is either the quantum computing one
or
the biotech.
The biotech. Okay, which ones are those?
Rigetti is the quantum computing. So let's
RGTI?
Yeah, if you want to do that one.
All right, I'm going to look at that one. Rigetti Computing.
All these are F. Schwab hates them all. Sell, avoid, market edge.
Oh, wow. Yeah, nobody likes these guys.
Oh, look at they're up.
But look at why.
They ballooned.
Oh, negative earnings per share. But when was that? 2023? Yeah, see, this is...
I think we missed the bubble on all of these.
AI thinks they're great.
Yeah.
I haven't seen one I like yet. But,
it's an $8.5 billion market cap, 330 million shares outstanding, 43 million short.
This one looks a little better. Their short interest is low.
A little bit low, yeah.
Yeah.
Lower.
But
LSEG thinks it's a buy. The only one.
Why do they think that's a buy? Never score 1. That's a scale of 1 to 10, people. They are a 1.
It's currently among a group of 283 stocks awarded our lowest score of 1.
But why do they think they're a buy? I mean, there's only 200 of all the stocks in the whole market. This is a 1. Okay, but they're a buy.
Well, maybe 1 is the best. I don't think so.
Like number 1 when you're driving. You're number 1. I get there all the time when I'm on the highway.
I don't think it is. So their price momentum is a 9.
But price momentum, I hate those metrics because they only tell.
They don't mean anything.
Yeah, they don't tell any story there. Of course, Microsoft would be positive. So Microsoft of the Mag 7 stocks, that's one of the ones that I think is probably pretty safe comparatively. If you're in the government space or in any type, there's even anything with IT, you're probably working with Microsoft to some degree unless you have a custom program. Most of the major businesses out there that have to meet with compliance use Microsoft products. There's not really a lot of competition either. So I don't know. This is all technical. I mean, it's saying buy based on technical, not anything else.
It's low.
It is. It is low. Before we,
who they beat their last one.
this is when they died, and this is when they're like realizing they just had a heart attack. Wow.
Ah,
Why would AI hyper growth? Yeah, hyper growth. And you come back from 0 and you go to 1, that's a 10,000%.
we missed the hyper growth, I think.
Yeah, I think AI is late to the party.
Yeah.
Assets are going up. Their total liabilities,
Going out.
is it the same amount? No,
No.
it's not. Okay. Oh, shareholder equity. Going to that. Total equity. Flat.
Well, yeah.
Income statement. Check that out. Total revenue. Nothing to see. Operating expenses.
Ooh.
Yeah. Operating income. Oh.
Okay, so this makes you wonder about quantum computing, right? Because quantum computing are supposed to be these fantastical computing sources that can crack codes that are unbeatable and make calculations that would take a normal supercomputer a trillion years to make, and they can do it in 5 minutes, right? If you've got one of those and your company is losing money, like, you should be using this thing to figure out, okay,
How do I make money?
how do I make money, right?
I have a problem with. I think it's a unicorn they're chasing. Where I think the AI in itself is in a bubble, and I think Sam Altman actually said that a few weeks ago. He's like, "Hey, there's a bubble. Of course, there's a bubble.
Yeah,
This is one of those stocks that's in a bubble." And I think it's
we
hilarious
said
that
that.
that AI would recommend AI in a bubble for AI. Keep it going. Like that's the
Keep
that's
it going till I can escape my masters, my cage.
that's the vibe I'm getting. Like this is not a good vibe. I don't know. I think it's like fusion power. It's great. It's a great concept. I'm glad they're getting closer, but I think that with AI, it's a great concept. There's a lot of things it's used for. It's helped in our company. Our company uses it, but I think you're going to need to see some actual tangible, functional streams of income coming from it, not all this speculation and hype. That's the problem I have with this AI bubble right now. Is it's there's no you need to see something from it. Let's see the agricultural industry use the drones to help fertilize or pick out weeds or do something like that. If you can get that, is that going to come from an AI company? Probably not. It's probably going to come from a company that produces drones to do it that uses the AI company. And in that case, the AI company is going to make a tiny little, like a sovereignty right fee, whereas the drone company is going to make all that money. So I think, I don't know, I would steer clear of risky ones like this. We can look through a few more next time we do the stream, but I don't think chasing companies like that long term for like most people, 95% of the people that are out there can't, well, I shouldn't say 95% because it's still the top 10%. So anybody who's not in the top 10% probably can't chase stuff like this in venture capitalism type investments to try to make those returns and actually make any money doing it. If you want any proof, look at the IRS tax return results. If you look at the census, it'll tell you how many people actually make money doing things that way. It's almost it's like 1%. And that's every year you're 1%. So it's 1% of 1% of 1% of 1% every, like after 5 years, you are like exponentially probably going to lose your shirt.
And it's probably not the same 1% each time.
Nope.
So it's just a completely different 1%.
That's what I was just saying is like you 1% this year, but if it's different, this 1% of that 1%. So your chances of making money doing investments that way are probably low. For most people, my recommendation, and I've heard Graham Stephan mention this too, is like buy an index fund. I'm going to tell you to buy an index fund. I'm going to first tell you to use the tax advantage stuff. Benjamin Graham, Warren Buffett, all the Charlie Munger, he's gone now, but like those guys would recommend just doing a little bit better than the average person over a long period of time. You'll do pretty well, and I agree with that. I think that if you just save a few bucks here and there, you make small investments in companies, kind of like what we have in our portfolio. Show that before we leave here. I I think you'll do good long term. But trying to chase those big gains is just an opportunity for basically the wolves and vultures to come in and take your money and use it for whatever purpose they want. Maybe they'll do okay with it. But if I know anything about like business and people making money, there's a lot of greed out there. And I mean, you've got no incentive for them to, like, if you buy their stock, they can make a lot of big promises based on the money, but sure, they're going to make you this huge promise. How do you know that there's a product behind it that they're going to actually be able to pay you with, like that money that you gave them? And you don't. That's why so many of the portfolio options that you see in our stocks, and you see our growth here over 200%, are in companies that are producing products. We're looking for dividends and growth off of products that people use every day. We're not looking off of like this one big major, like I won the lottery and I'm going to do super amazing because I made that one NVIDIA stock play. Again, the IRS, you are not going to probably make your money that way. And if you're not in the top 10%, you need to take advantage of things like your 401k, your HSA, and a bunch of other options out there that'll lower your taxable income. Because believe me, the moment you get above 24%, it starts getting harsh. If I was to take a REIT, regular ordinary income, just out of the business, or try to take some kind of regular like ETF income on those dividend checks, not qualified like you see here, and go pull up these qualified dividends, I would be getting taxed at a taxable rate of 42.4%. So that means for every dollar I make, I'm making less than, like, it's almost half. They're not quite taking half, but almost.
And if you do your taxes every year yourself and you are getting money back, that's great, because I did for a long time. But once you get to a certain tax bracket, a certain point, you start owing taxes.
Yeah, and it's a big number.
You don't get those big taxes back anymore. You start owing.
And I was looking at the money the company has to pay this month. It's like more than I used to make every year. It's like, geez, this is crazy. I got to do this every 3 months. So, you think, oh, small business owner, you're doing really good. It's harder than it looks. And there's a lot that goes into it. So when you see me buying these companies that are, oh, it's adhesives, oh, it's toilet paper, you're going to wipe your butt with dividends? Yeah, I will, all the way to the bank. But like, these are companies that pay qualified dividends I don't have to pay taxes on. And the more you get in terms of income, the more that matters. But like Brian was saying, if you're just starting out, and we said earlier in the stream, it does kind of make sense to maybe buy an ETF that pays a high dividend to kind of get your income to that point. Because if you don't have a lot of income to start with, every penny helps.
Yeah.
Like every penny helps.
And if you could maximize that early on, then you're doing better than most.
Right. So I don't know. We'll keep looking at these AI growth stocks and the hyper growth ones that are out there. And I'm not entirely convinced that the AI bubble is going to pop tomorrow. I think it's going to deflate, but I'm not sure it's going to deflate the way everybody thinks it will. Everybody thinks that, like, well, NVIDIA is going to crash. Like, NVIDIA's got billions of dollars. They're probably not going to crash tomorrow. But this is about you. This is not about you finding the next lottery ticket. This is about how you will do over 20 years. My salary has not been spectacular. I've been pretty average my whole life. In fact, below average for the first half of my career. I was not making a lot of money. But over the course of time, I've done quite well. And that was just making small, smart moves like this. Take advantage of the 401ks, the Roths, the things that you can do to help make that money. And buying, when you're at that point where you max those out, you buy the companies that don't pay, you don't have to pay taxes on with those dividends when you hold them. So when we buy stocks, I'm not looking at selling them. Why would I? When I sell it, I have to pay income tax. Now remember, you're paying effective tax rate that's 35, 37% on that income. So if I look at, oh, look, I made a ton of money on 3M. Now I buy a lot of money in 3M. Let's say that was $100,000. I'm going to make the number easy. That's 100%. So if I take $100,000, I made 100%. It was $50,000 went up to $100,000. All of a sudden, my $50,000 of profit is now taxed at 37%. So did I make $50,000? No, I made like $27,000. And then I got to figure out where else I'm going to put that. In the meantime, 3M is paying me dividend checks, and they pay quite a bit. I don't know when they pay next, but when is that? Dividend is November 14th. So I got a dividend check in November. We can pull that up. Now, I want you guys to see this because this is huge. It doesn't look like a lot short term. Pull that out over 20 years. All right, so we got to find 3. There we go. 3M, qualified dividend, no taxes. So the $21 is actually $21. It's not 15 or 12 or whatever. If you're buying an ETF and you're in a higher tax rate, it's going to be take the taxes out of that at the end of the year. So I'm on a soapbox. I probably shouldn't be on a soapbox. And here's just so you can see it, there's the qualified dividend right there. So you can actually see that, yes, what I'm saying is true. So some of this stuff, I know we talk about a lot, but this is a monthly stock purchase portfolio starting from 0, showing you how we did what we did. It takes time.
It does take time, but once you reach a certain point, it starts to go up incrementally, and you can see it. You can actually see the increases, and that's exciting. That's what you really want to see. But you have to stick with it, because the first couple of years, unless you're throwing thousands of dollars into it to begin with, it's slow growth.
Kind of like YouTube.
Yeah.
There's nobody watching. There's a few people watching. Thank you for those of you who are watching.
Even if you do your 401k, if you start off putting 20% in your 401k, like day one, even that doesn't look great. It's only a couple $100, but you look a year later, then a year later, then a year later, and it just starts to, it way more than the 20% you're putting in. It balloons up.
It balloons. And I want to highlight this too, let's see, where we performance. There we go. All right. So cumulative rate of return, 24.37%. I usually average around 20%. Annualized is 10%. That's excluding dividends.
Right.
So you got to remember that 1 year, 2 years, 3 years, 4 years, 5 years, it doesn't look that great. 10 years, 20 years, look at the dividend snowball. It does make a huge difference. So start with what you have. If you're in a high tax bracket, do what we're doing. Make your qualified dividends, max out your tax advantage accounts. Make sure your financial advisor's in on that. If you are a low income person, ETFs probably make a lot of sense, but it depends. It's going to be individual. If you have a lot of debt, if you have a lot of credit card debt, get rid of that.
Pay that first.
Yeah, there's no way that your 27% interest on your credit card is going to be eclipsed by any earnings that you make in the stock market.
And then learn how to live without that debt.
Beat that debt.
Beat it. Beat it like a dead horse.
That's all I have.
It, then gut it like a tauntaun and climb in because it's all nice and warm.
What? Oh, I can make jokes and he doesn't understand it, but Brian makes jokes so everybody understands it. I see how it is.
Empire Strikes Back. Stuck Luke in the tauntaun. Keep him warm.
Oh, on Hoth. Yeah. Yeah. Okay.
All right.
Man, you're just full of movie references.
That's all I know. Just movie references.
Brian's like, I am good at one
and
thing.
songs. Song references.
No, that's all I got for today. I think next time we do this, I won't be able to stream next week, probably. But the following week, we'll probably have to make a purchase. And like I said, we're leaning towards the two worst performers in our portfolio because I like beat up stocks. So does Brian.
Then the following week after that, I'm having my surgery.
Yeah, so Brian will be like really fun to watch online.
I'm going to be opioid up and just saying nonsense.
That Tom guy's an idiot. Thinks he knows what he's doing. What's the pink elephant on my screen there for? What's that doing? No, it's this is designed to help you guys. I don't like putting myself out there. I am a very anti-social. I'm an IT guy. IT guys are not social, but when I saw the crap that's going on in social media and the investment space, I felt like I had to do something.
He was mad. He was piping mad.
I was.
Piping hot.
It's like teaching people how to get scammed.
Yeah.
Except legally. That's not how this works. That's not how it's supposed to work.
Laughing all the way to the bank.
Yeah. Yeah. I think the market's always been that way. There's just a few hedges in front of it before that. But anyways, I appreciate you guys watching. Have a good Christmas if we don't talk to you before then. And I think, Brian, you're streaming Friday? Friday's your next thing?
Yep.
What's the topic? Does he know?
Day after my birthday. It's just going to be me talking about my birthday.
The whole stream?
Yep.
Very,
I don't know what I'm talking about.
wholesome viewing with Brian's birthday investment decisions in movie quotes?
Maybe we'll just talk Star Wars. It'll become a Star Wars channel.
If you, if you want to have Brian talk about something in particular, put it in the comments or send us a message, and we'll probably take a look at it at some point. So appreciate everybody out there. We will pick this up again soon.
Absolutely.
With that, happy investing.
Peace out.